Welcome to TMS Insights, the April edition. Ben Clark and Jeremy Hook bring you some of the news. It's been a really rampant time in the market, Ben. The March quarter ended, it was a negative one, down for the quarter 4%. So it was tough, It was a tough time. And maybe just starting there with that as a theme, Ben. I mean, this market has thrown up a lot of challenges. I think we've warned people through these insights videos about how we saw the top part of the market delivering yield but not a lot of growth. That certainly played out, but sentiment still remains pretty low in the market.
Absolutely, and I think that it comes back to that point, Jeremy, which is that the stocks that drive the index, by and large, look like they have a lack of revenue growth. And I think over the last 5 years post GFC, they've done a lot of work on the cost side of the businesses, and that's starting to peter out now. And so the earnings growth now that you're seeing is pretty sort of lackadaisical, and therefore PE levels are coming down to sort of discounts to what we've seen historically. And probably the banks are being one of the hardest hit areas of the market, and probably a great sort of case in point of what's going on there.
And we were talking just before the video about how it feels relative to other times in the market, and we both pretty much agreed that it felt a bit like 2003, particularly equities versus property, and just how the property markets are clearly done well, and there's now a belief that they're topping out, and yet still that remains is maybe that there's a lack of love for equities.
Yeah, absolutely. Well, look, it reminds me a lot of it. I remember seeing a lot of retail clients back then who were, we had that post-housing market boom up here in Sydney, and post-Olympics housing boom, and there was this view that was just going to continue, and property markets never fall, and that's the place to be. And during that time, the Aussie market had a 2-year sort of bear market, and it reminds me a bit of the same, because when you look at the yields now you're getting on property, you probably you buy a house in Sydney, you're probably getting about 1.5 to 2% as a net yield. You can buy CommBank now and get about a 10% dividend yield on their shares, and you're buying pretty decent valuation as well. So you could see that crossover happening. I think we've got another tricky sort of 6 months.
6 months or so where it does that, and then all of a sudden equity returns could begin to take a good run here, and then people will be wondering what the fuss was all about. But you don't want to lose faith after a difficult period, which it's been, about good value things. We don't precisely know when they're going to turn around, but we've given a bit of an inclination there that we can see this year remaining a bit tough, but ending probably a little bit more positively than it looks at the moment. And it actually leads into a viewer question, which we've taken, and we're happy to take more as it goes on. The question, again from a client, is about the level of the market at the moment, and in particular with negative interest rates overseas. Will that lead to buying into the Australian equities market with favourable currency at the low and mid-70s level on the dollar? And we know obviously the dollar's pushed up a bit, but most banks have still got lower forecasts for it. But Ben, is that a factor we should see at some point? Will we see foreign buying?
I think so. Yeah, because I think I think we've got this tricky sort of period, but I think ultimately what will see the market bottom out will be valuation, and then there'll be some sort of catalyst. And the only thing I would say is I think in some of the higher yielding stocks, they can become value traps in that the dividend yield is actually too high. You look at Woolworths, etc., as a bit of an example, or BHP. And so you've got to approach it on a case-by-case basis. Is the dividend sustainable? And whether it's offshore investors that step up and start buying that because their returns overseas are low, or whether it's local investors because certainly our interest rate environment looks pretty benign for the next for the medium term. Yes, I think there will be a point at which that'll help to create a floor under some of those share prices.
Okay, excellent. And I think that might lead us on to an important discussion about the bank sector. We've sort of made some comments there, but Ben, they've had another sell-off in the banks in the last couple of weeks. ANZ, $100 million additional bad and doubtful exposure announced, and not much else apart from just general sector concerns, largely property related.
Yeah, and look, I for me the biggest thing out there, probably retail clients aren't quite as understanding of is the capital raising side of these businesses. Sure. Last year we saw significant raisings done by the banks, and not to invest for growth, but just to sit on cash, which hinders, a lot of financial metrics of the companies. And I think a couple of weeks ago, we probably got the clearest indication yet from APRA that they want the banks to raise further capital. And when you speak to institutions who really sort of set the prices that these shares trade at, you get the feeling they're quite comfortable being underweight the banks at the moment, with a view that they'll increase their holdings in those raisings. Yeah. And so, and I, personally, I think the raisings look very likely. But I also think that when the banks get this second round of raisings done, it could be when the market starts its recovery, because they're such a big component of our index still. And once I think that gets done and it's in the rear view mirror, looking forward, and with the valuations we're seeing, I think money will start to come back in for the banks. So
yeah, and it's interesting, back testing to the early 90s when Australia was in recession. The time to buy the banks was after the second capital raising.
Yeah, absolutely.
Or on that second capital raising. And again, that didn't turn out to be the case in the post-GFC, because they didn't have to go deep into that capital raising cycle. They went once only. They've gone once in this cycle, which was last year. They go again. Watch that as a timing point for a turnaround. Yep. Ben, I want to talk about Telstra, which had an announcement over the weekend about Auto Home that they've sold their stake in.
Yeah.
A material transaction. And also in that sector, which reported recently, TPG, and just a bit of a comparison.
Yeah, look, I obviously good news for the Telstra balance sheet, which looks in good shape. It's nearly $2 billion they secured for the sale of Auto Home on the New York Stock Exchange. And look, the recent growth from Telstra you wouldn't say is great. The dividend looks very sustainable for a fair period of time whilst...
And this sale could lead to other special dividends or
absolutely
buybacks, etc. Yeah?
Yep. But I think, TPG is interesting to look at in when you look at the earnings growth that company's delivering, what they're streets ahead of Telstra and rapidly taking market share continuing to in the ADSL market. And, certainly one longer term concern I have with Telstra is that what we've seen happen in ADSL over the last decade, which has been sharper and sharper margins and loss of market share from the incumbent, could happen in the mobile market in the next decade. As everyone's the plans are getting cheaper, the data allowances are getting greater, and Telstra either has to match the competition, which it failed to do in ADSL, or give up market share. Yeah. And it neither is a nice sort of outcome, and how they manage that I think is going to be tricky. But for now the balance sheet looks great and it looks pretty stable, doesn't it? Yeah,
it does, yeah. And mentioning TPG, though it's not really a mid-cap, it's become a sizable business now, takes us into probably looking at some of those more interesting stocks that do exist despite the overall index level of the market. There's actually been some stocks that we've been talking about that have performed well and still look good. CSL looks pretty good, doesn't it, Ben? REA Group. We've been liking Isentia as another of those stocks. Again, eclectic stocks.
Yep.
Some of them quite large, some of them not so large. But digging around and finding those companies is everything.
Absolutely. And I think it highlights, because every bear market's different, every bull market's different. And the unusual thing I think about the last year has been the number of stocks that we've seen actually hitting all-time highs in a market that's been weak. And it just goes to show that the market will still reward a company for delivering great financial performance. Yeah. Where it's disinterested is in companies that are, there's not that sort of catalyst and there's not that sort of growth associated with the businesses. So you've got to keep focusing, I think, and particularly as a retail client, I think you've got to, if you're looking for growth, you've got to be a bit more interested in looking outside the blue chip household names. And that's what we've tried to we'll communicate.
Really have to continue to and look to bring new ideas again to you. So that's all we've got time for today on this edition. We look forward to bringing you more news in May.